Hi, I'm Nick Mersch at Purpose Investments, and in this brief video, I'm going to go over the mechanics of how a covered call strategy works. A covered call strategy is when you own or are buying stocks, and at the same time, you write or sell a call option on a share-for-share basis. This strategy is typically used when the owner of underlying stock wishes to generate yield with the belief the stock will not rise above a certain price ceiling over a certain period. When you write a call option, you are selling a contract that gives the buyer the right, but not the obligation, to buy the stock at a predetermined price called the strike price. This call option has value when the stock price exceeds the strike price because the owner of the contract can buy the stock at the lower predetermined strike price, then turn around to sell the position in the open market for a profit. If the stock price is under the strike price, the buyer of the contract will choose not to exercise the contract and let the contract expire worthless. While owning the underlying stock is relatively straightforward, we need to understand how the call option comes into play. We will begin from the contract buyer's point of view to understand the incentive structure. Let's go through two scenarios. The first is when the stock price goes above the strike, where the call option is in the money. In this scenario, there is a buyer of one call contract at 100 shares per contract for $300, or $3 per share, at a strike price of 105. The hope here is that the stock will exceed 105. If the price of the underlying stock exceeds the strike price before contract expiration, the contract buyer will exercise the call option and buy the stock at the lower strike price. They can then sell the stock in the open market at the higher current price for more money than they bought it, therefore locking in a profit. The contract in this scenario is said to be in the money, and the value of the contract is therefore positive. The total profit to the contract buyer has two components. The first is the value of the contract. This is equal to the amount that the stock price exceeds the strike price times the number of shares. In this case, it's $500. The second is the cost of the contract, or the option premium. The buyer must pay this premium in order to enter the contract, in this case, $300. So the profit to the contract buyer is the value of the contract minus the cost of the contract for a total profit of $200. This provides incentive for the buyer of the option to exercise the contract. The next scenario is when the stock price is below the strike, where the call option is out of the money. In this case, stock only appreciates to 104. If the price of the underlying stock is lower than the strike price at expiration of the contract buyer will choose not to exercise the option. As we can see, the contract value here would be negative. But remember, they have the right but not the obligation to enter this contract, so they will choose not to exercise and let the option contract expire worthless. Now let's take our understanding of call options and apply this to a covered call strategy, which again is long the underlying and short the call option. In this scenario, there is an owner of a stock that has purchased 100 shares of stock A for $100. They have also sold one call contract, 100 shares per contract, for $300 at a strike price of 105. Again, the stock price appreciates to 110. Since the stock price is above the strike price, the stock will be called away, and you would be forced to sell the stock to the contract buyer at 105. So you still gain on the stock, selling it above your cost of 100 for a profit of $500. You also benefit from the gain on the premium from selling the contract. So the total gain comes out to $800. The main cost on the upside is opportunity cost. The gain on holding only the underlying without the option is $1,000 versus the $800 from the covered call strategy. So you're giving up potential upside in return for the premium or the yield that you generate. For the final scenario, we've saved the best for last. In this case, under the same scenario, the stock only appreciates to 104. Since the stock price is lower than the exercise price, as we saw above, the contract buyer will choose not to exercise. The contract expires worthless, and you collect the premium of $300 as well as a gain on the underlying of $400 for a total gain of $700. So there was an opportunity cost of $200 in the previous example, but in this case, you pocket the extra $300 on the premium. In summary, covered calls provide the investor with yield generation on the underlying security with the belief that the stock price will not rise above the exercise price. Covered call strategies will underperform versus owning just the underlying and strong up markets, as upside is given up when getting called in. It will outperform in a down market as the yield will dampen the downside effect, and it performs best in a sideways market that preserves the equity position of the underlying while generating its attractive yield. Thanks for watching. And join back next time for a single stock ETF covered call strategy that is different than any other product on the market.